Hey, what's up guys? John here. The audio industry and the housing industry are a house of cards. I saw this video on Twitter. I'm going to share it with you because it highlights just what's happening in the auto industry, and I'm going to show you behind the scenes of what's going on in the housing market because this is unreal. Take a look at this. Please hit the like button. YouTube will share the content, educate the people about what's really going on, and if you want to fix your credit to position yourself for the greatest wealth transfer of all time, which we are in right now, there's no denying it. Go to greatcreditfast.com. That's greatcreditfast.com. If you have late payments, medical bills, charge-offs, foreclosures, bankruptcies, repossessions, any negative item on your credit report, go to greatcreditfast.com. We're stepping into an incredible opportunity to invest. You're going to want access to money, and it's only possible in this type of environment with great credit. Go to greatcreditfast.com. Click the link below in the description. Schedule a free strategy session. Take a look at this.
76% of the people that went into dealerships to get a car with a synthetic identity last year had gotten a PPP loan the prior year.
Oh, look at that correlation.
Yeah, there was a very strong correlation. And that's why auto fraud is up so much this year, because it's not PPP anymore. It's not unemployment fraud anymore. It's car loans. And that's why I think we're seeing this shift upwards, and while these dealers are getting hit.
76%. Well, what is happening right now? The housing industry, the job market, everything was supported by these record low interest rates and all this money put into the system. Remember the Great Resignation? People were making way more money just a year and a half, 2 years ago than many are making today. And as that's happening, inflation is getting much, much worse. But there's a very unique dynamic that's unfolding in the housing market. Many people don't realize that the average down payment for a first-time buyer was only 6%, just a 6% down payment. So if you were to list a property and buy a property, put 6% down, and then you wanted to sell it the following day, you would pay at least 5% for realtor fees. 2.5% to the listing agent, 2.5% to the buyer's agent. Plus you'd have transfer taxes, closing costs, any type of any other problems that come up during your escrow, during your transaction. Usually it's between 8 and 10% of the cost of your property just to sell it. And so all these people that bought these properties at the height of the market are in very big trouble if they paid, the top of the market prices for them. A lot of these people are not going to write a check to leave. A lot of these people, when insurance is going up, property tax is going up, the job market's starting to fall apart, they're going to start giving the keys back to the bank. They're going to start renting out their homes. Here's just how big this problem is. It's 40% of all U.S. mortgages were originated at the height of the market. So all these people locked into these record low interest rates. You just ask yourself this big question. If they bought these properties with a 30 or 32% debt to income ratio, meaning they're making 10 grand a month and they're spending $3,200 on a mortgage payment, that debt to income ratio changes dramatically if insurance continues to increase at 10, 15, 20% a year. In South Florida and other locations, it's increasing even faster than that. Taxes going up, yet wages are falling. What does that mean? It means people, no matter how low their interest rate is on their home, if they're only bringing in X and their expenses are continuing to increase, it's not going to be enough, right? We're going to start to see a massive problem unfold, especially on the back of these record high interest rates, as interest rates for mortgages have just hit a multi-decade high. If you have above average credit in America, the average credit score is a 698. So if you have a 700 to a 719 credit score, it's 8.269%. Now, 18 months ago, 2 years ago, that was a 3% mortgage. You could have bad credit and get a 3.25% or 3.5% mortgage. Credit really didn't matter so much. But now, 640, you're almost at 9%. Right? If you have a 620, you're in the 8.8, almost 8.9%. You're about 9% mortgage. This is unbelievable. So you think about this. What does this mean for people that, they're stepping into student loans in 3 days? What is this going to mean? People are going to start defaulting on bills. Their credit score is going to go down. They're going to have less access to capital. And as that's happening, the job market is going to start to continue to likely erode. And we're going to start to see a lot of investors sitting on more and more and more capital looking at this essentially all-you-can-eat buffet, which is going to be the U.S. housing market coming very, very soon. Now, just for context, if you were to buy a $500,000 house with 6% down, which is the average down payment in America, with an 8% mortgage. So being kind of conservative, 8% mortgage is $4,200 a month. Average, $4,200 a month. Now, the traditional home in America, just for context, is $419,000. So that would be $3,566 for the average property with a $25,000 down payment, plus you're going to need reserves. The lender's going to want to see 6 months, usually 6 months reserves in the bank. So you're probably going to need somewhere around $40,000, $50,000 in cash to walk into a $3,600 a month mortgage payment. Why would someone do that when they could rent? The average rent in America right now is about $2,000, a little bit less depending on the area. So why would someone go spend 50% more, 40% more to buy a property in which the costs are really going to likely increase in the short term with insurance and taxes? But something very interesting is happening. U.S. pending home sales fallen 44% from its peak. 44%. This is only just the beginning for the U.S. housing market. Pending home sales fall 7.1% in August. This came out this morning. August may be the beginning of the economic resilient housing market. So it's 100%. 100% going to be the beginning. Because you think about it this way as well. During the holiday season, what do people generally do? They put more debt on their credit cards. They travel more. They buy gifts. They do massive changes in their lives during the holiday season. But we're seeing right now 1 out of 10 properties that are selling are being sold because bosses are forcing their employees back into the office. So people are going to start to get a little bit more desperate as this great resignation flips on its head. And rather than employees having all the power in the negotiation, it goes the other way, where the bosses have more and more power and more authority in this negotiation. So mirroring the trend for new home sales, pending home sales fell 7.1% in August, according to data released Thursday by the National Association of Realtors. All 4 regions of the U.S. posted month-over-month and year-over-year declines in transactions. Home payments as a percentage of median income by state: 68% for Hawaii, 67% for California, 57% for Montana, Oregon 55%, Washington 54%, Massachusetts 53%, Idaho 52%. You start to do the math here, you have to also take into consideration one moving variable that no one's really talking about. Wages have hit an all-time high, and they're only going down from here. I don't care what anyone says. If you look at the data, that's what it shows. We're stepping into a situation, a dynamic in this economy, in which a lot of these problems that were created by humans will be solved by machine learning, AI, robotics, and technology in the years to come. Meaning more and more weight will be dependent on these sectors, whether it be in service, whether it be in secretarial work, whether it be in almost any industry. Every industry is going to be impacted over the years to come. And so when you look at this, how can people look at their current debt to income ratio right now? The average person you look at $17 trillion, roughly $17 trillion in outstanding consumer debt, with a dynamic in which wages are going to continue to likely decline, interest rates are going to continue to rise in the short term, defaults are going to continue to grow, and banks are going to have to refinance over $1.5 trillion in commercial loans over the next 12 months and $2.7 trillion from now until 2027. And they say, no, there's not going to be any problems here. But also, you have this huge problem that's happening with seniors right now that is not getting any attention. More seniors are becoming homeless, and experts say this trend is likely to increase. They own, by the way, 55% of all homes in America, people between 55 and older, right? So all these seniors, a lot of them are walking into financial hardship, not planning ahead for this record high inflation, not planning ahead for this expensive world we live in. Many of these people are going to have a situation in which they're going to have to sell their properties, they're going to burn out their properties, they're going to have to make very tough decisions. And if you look at the trend showing from where it was in 1990, so the percentage older than 50 had increased 11% in 1990 to around 37% in 2003. In subsequent studies, the research group found that a number has risen to 50% today. Elderly homeless has been rare within the contemporary homeless problem. We've always had very few people over 60 who've been homeless historically, but of course that's changed as this group has come in. It's now arguably the fastest rising group. So I'm not sure if this is the form of combating inequality, but this is combating America, right? Combating America's growth, combating America's potential to have a good life, a really strong, prosperous family environment where people can take care of their kids, their grandkids, they can't take care of no one can really take care of anyone at this age. If you're in retirement sector, you're 55, 60, 65. You'd have to retire as a multi-millionaire, or at least a single-digit millionaire, or have very low cost of living, and you're really making smart decisions. It's an unfortunate scenario that we're in. It really is. Because America was the land of opportunity, and that opportunity is slowly fading. Ray Dalio said that the U.S. is going to have a debt crisis. Well, that's obvious at this point. But he came out today saying that we're going to have a debt crisis in this country. The founder of the hedge fund Bridgewater said in an interview with CNBC, Sarah Eisen, that aired on Thursday. The two were speaking at a fireside chat in Managed Funds Association. How fast it transpires, I think it's going to be a function, the supply-demand issue. I'm also watching that very closely. The U.S. debt levels surpassed $33 trillion for the first time this month as lawmakers negotiate U.S. spending bills for October 1st. A failure to reach an agreement would mean a government shutdown and raise the perceived risk of the country's debt. What do you think of this situation? Do you think we're walking into a scenario in which a lot of people that locked in very, very low interest rates are going to have a hard time holding on as everything starts to turn? Do you think we're going to walk into a situation where a lot of auto repossessions are only going to continue to rise? And do you think we're going to walk into a situation where a lot of retirees are going to be hit with this massive surprise and be forced to sell off their assets? Meanwhile, there's over $5.4 trillion in cash sitting in money market accounts right now. The wealthy are getting rid of tons and tons of stock. A lot of wealthy CEOs are stepping down from their positions. It looks like they're getting ready for this massive wealth transfer on the middle class. And it's almost a guarantee at this point. At least that's what the actions of the elite, the wealthy, are saying, that they're preparing themselves for a massive, massive buying opportunity. They're saying that by 2030, in the next 6 years, they will own 40% of all single-family homes in America. Currently, they say they own 5%. So an 800% increase in the next 6 years. How are they going to do that? We're in the greatest wealth transfer of all time, the Great Rug Pull. We're in it right now. All that's left is the pull, which is happening. If you want to fix your credit to position yourself for the Great Rug Pull, for what's happening, go to greatcreditfast.com. Schedule a free strategy session below at greatcreditfast.com. Takes 2 seconds. Schedule a call. See how we can help you fix your credit to position yourself for what I think is going to be one of the greatest investing opportunities of our lifetime. Catch you guys in the next video.